Welcome to Charts That Count. It's the second week of January 2020, and the U.S. stock market is hitting an all-time high. And in recent weeks and months, the momentum has been particularly strong. All of which raises a question. If slowing earnings growth, a soft industrial economy, a simmering trade conflict, military conflict in the Middle East, and sky-high valuations aren't enough to slow down the stock market, what on earth is? Here you have a 5-year chart of the S&P 500. And over those 5 years, the index is up 60%. That's 80% if you include dividends. And yet, over just the last year, think of all the things that have happened. Over the year as a whole, we have seen virtually no earnings growth in aggregate among S&P 500 companies. Over just the last 4 months of the year, here, we have seen 4 consecutive months of contraction in the industrial economy, according to the ISM surveys of companies. Here, of course, just in recent weeks, we've seen conflict with Iran. At the same time, though, the valuation of the stock market is near its all-time peaks. The cyclically adjusted price-to-earnings ratio is a dizzying 31. Let's not forget also what happened in September, when money markets froze up and the Fed was forced to come in and inject liquidity. So there's been a tremendous rally, but not that much good news. And in fact, the rally, while it's been sharp, has not been deep. About a quarter of the stock market returns last year were taken up by just 5 big stocks, the likes of Apple, Microsoft, Facebook, Google, and so forth. Now, none of this, by a long stretch, amounts to a good argument for why we should have a stock market crash anytime soon, or even a steep decline. It does, however, make you wonder whether this furious rally is sustainable. Now, the stock market bulls have a very simple argument in support of their optimism. It is not only one word, it is 3 letters long, and those are FED. The bulls believe as so long as the Fed keeps monetary policy loose and rates low, the stock market will continue to go up. Well, maybe. And in fact, following the Fed over not only the last 5 years, but over the last decade has been a great plan. A word of warning, though. Historically, there is not a clear relationship between low rates and stock valuations. In fact, the relationship has been all over the place. The stock market looks strong. The economy, in some respects, such as the consumer area, remains robust. The Fed is in fact powerful. It is not, however, all powerful. Happy 2020.